Welcome to TalkTickers. We're the place you come to really understand earnings calls, not just get the headlines.
We cut through the noise, get into the details.
Exactly. Today, we're taking a close look at Kamada Ltd's Q2 2025 earnings call. Now, on the surface, it looked pretty good, a definite win. But did it really, move the needle strategically? That's what we want to unpack.
Yeah, there's more nuance there, I think, beyond just the headline numbers.
We'll dig into their profitability, that four-pillar growth strategy they keep mentioning, and try to figure out what this quarter really tells us about where Kamada's heading and what it means for you.
It was a fascinating call, for sure. A win is fair, but digging deeper reveals the strategic thinking, which is key.
Okay, let's jump right in. The snapshot results for Q2 2025. The big thing that really popped out was the profit beat.
Definitely.
GAAP EPS of $0.13 per share. Now, that's their profit per share using standard accounting rules. Analysts only expected the 0.9 cents.
That's a huge beat, 44% surprise on the upside.
Right. To me, that just screams, operational efficiency. They're managing costs well.
It's a really strong signal. Now, revenue came in at $44.8 million.
Just a little shy of the $45.1 million consensus.
A whisker shy, yeah.
Yeah.
But importantly, still up 5.4% compared to last year. So still growing.
Okay.
But here's where management really showed their confidence. They actually raised their adjusted EBITDA guidance for the full year.
Okay. That's significant.
Yeah, they're now projecting $40 million to $44 million. That's up from the previous range of $38 million to $42 million.
So not just a tiny adjustment, that's a meaningful bump in their profitability outlook for the whole year.
Precisely. And they did that while reaffirming their full-year revenue guidance, kept that solid between $178 million and $182 million.
So beat on earnings, raised profit guidance, kept revenue outlook stable. That combo must have sparked some excitement.
Oh, it did. We saw a really positive indication pre-market. Definitely some enthusiasm there.
What do you make of that, though, that initial pop?
Totally understandable, given the numbers. Strong performance, better profit outlook, it makes sense.
But it softened a bit by the end of the day.
Yeah, as often happens.
Yeah.
The market kind of digested the news, maybe some profit taking after the initial jump, or just investors stepping back to look at the details.
Right. Standard market stuff, absorbing the info, recalibrating.
Exactly. Doesn't necessarily mean anything's wrong fundamentally.
Yeah.
You got to look past that initial reaction.
And if you do look deeper, the financials are pretty solid, aren't they? Q2 adjusted EBITDA. Remind us what that is again.
Right. EBITDA is earnings before interest, taxes, depreciation, and amortization. It gives you a clearer view of the core operating profitability.
Got it. So Q2 adjusted EBITDA was $10.9 million.
Yep, $10.9 million. That's a 20% increase year over year.
Yeah.
And importantly, a 24% margin.
24%. That suggests they're getting better at turning revenue into actual profit. More efficient.
That's the key takeaway. That margin signals efficiency. And look at the first half of 2025 overall. Revenue for the first 6 months, $88.8 million, up 11% year over year. Pretty good growth.
And the adjusted EBITDA for the first half.
Even better, $22.5 million. That's a 35% increase compared to the first half of last year.
Wow, 35%.
Yeah, representing a 25% margin for the half year.
So profits growing much faster than revenue. That's what you want to see.
Exactly. It tells you they're building a really efficient engine. Even modest sales growth can turn into bigger bottom line returns. Frees up cash for, strategic moves.
Okay, let's talk gross profit, though. It was strong, $18.9 million for Q2, a 42% margin. But that is down slightly from 45% last year. Should we be concerned? What's behind that dip?
That's a good catch, but no, not really a red flag when you see why. It's about the mix.
Product mix?
Territory mix. Both, actually. They had higher sales outside the U.S., particularly for Glacia. International sales are great. Very profitable overall.
But the margin percentage might be slightly different.
Exactly. Things like pricing, distribution costs, they can vary by region. So even if total profit dollars are up, the percentage margin might dip a bit because of that shift in mix. It's a natural part of expanding globally.
Okay, that makes sense. Transparency there is good. And they're generating cash too, right?
Yep, $8.0 million in operating cash flow in Q2. And they're sitting on a nice pile of cash. $75.5 million as of June 30th.
That's a strong cash position. Give them flexibility.
A lot of flexibility. And you see that reflected in their priorities, their strategy. It's not just a cushion, it's fuel.
So let's pivot to those growth drivers. What specifically fueled the first half performance?
Management pointed to a few key things. Increased sales of Glacia outside the U.S., like we just mentioned.
Okay.
Also, VARIZIG sales in the U.S. were strong, and they saw good royalty payments coming in for Glacia.
So a mix from their commercial portfolio.
Yeah, it shows the diversity. They can pull levers in different areas.
And it's not like their other products are lagging. Cadra, Cytogam.
No, they said those are performing as expected. Actually, with Cytogam, they've started a big post-marketing research program.
Putting more research into an established product. Why?
It's smart. Cytogam is used for CMV disease management. That's cytomegalovirus.
Right. Can be serious for certain patients.
Exactly. So this research aims to show even more advantages. Things like preventing late-onset CMV, handling active disease better, maybe finding new ways to dose it or new uses altogether.
So it could expand the market for a product they already have, find new growth avenues.
Precisely. Unlock more organic growth from an existing asset. Give it a second life, maybe.
Clever. Okay, so beyond optimizing what they have, let's talk about that 4-pillar growth strategy. It sounds corporate, but it seems like a real roadmap.
It is. It's pretty clear how they plan to grow. Pillar 1 is organic commercial growth.
And what's driving that specifically?
A big piece is launching biosimilars in Israel. They launched the first one last year.
How's that doing?
Expected to bring in about $2.5 million this year. But the bigger story is they plan to launch 2 more by the end of this year, 2025.
2 more biosimilars.
Yep. And they project that whole portfolio could hit $15 million to $20 million in annual sales within 5 years.
15 to 20 million. That's a significant new revenue stream just in Israel.
Totally new, diversified stream using their existing setup there. And it's not just Israel. They're winning more tenders outside the U.S. too.
Right. You mentioned VARIZIG earlier. There was that big Latin America contract.
Exactly. A $25 million contract for KAMRAB and VARIZIG running from 2025 through 2027.
That kind of multi-year deal provides stability, doesn't it?
Huge stability. It shows strong global demand and gives them predictable revenue complementing the U.S. market. Diversifies their risk.
Okay, pillar 2. Business development and M&A, this is where that cash comes in handy.
You got it. They said they're actively doing due diligence on several potential targets.
What kind of targets?
Mostly focused on plasma-derived products, which is their bread and butter, and also specialty pharma, especially in the transplantation field.
Transplantation, why that area? What's the synergy?
Good question. It often involves complex, high-value treatments for specific patient groups. Kamada could leverage their hospital sales force, their expertise, maybe even their plasma supply.
Like an anti-rejection drug or something?
Maybe. Yeah. Or diagnostic.
Yeah.
Something that fits their commercial channels. They want to use their cash, create real operational synergies.
And they think this could impact results soon.
Yeah. They mentioned potential meaningful impact on 2026 performance. So keep an eye out for deal announcements.
All right. Pillar 3, plasma collection operations. This feels like a really big deal. The FDA approval for the new Houston Plasma Center.
It is a very big deal, announced August 11th. This is potentially transformative for them.
Why? What makes this Houston center so pivotal?
Okay, 2 things. First, capacity. It can collect about 50,000 liters of plasma per year. That's massive.
50,000 liters. Wow.
At full tilt, they expect it could generate $8 million to $10 million a year just by selling the excess plasma they collect.
Selling plasma, not just using it themselves.
Both. That's the second critical point. It diversifies their own supply chain, makes them less reliant on others, but crucially, it lets them sell surplus plasma into the market.
And that market is tight, right? Plasma supply.
Very tight. Demand often outstrips supply for immunoglobulins made from plasma. So being able to sell plasma gives them a strong position and boosts cash generation. It's strategic control.
They already have centers in San Antonio and Beaumont, Texas.
Correct. Houston really solidifies that U.S. plasma collection footprint. And there's potential for more.
How so?
They're expecting an ENA follow-up by year-end. That's the European Medicines Agency. Approval there could open up plasma sales to Europe, too.
Another catalyst to watch. Okay, pillar 4. This sounds like the long-term potential play, the Innovate program.
Definitely the highest potential upside, maybe the highest risk, too. It's their phase 3 trial for an inhaled therapy for alpha-1 antitrypsin deficiency, AATD.
AATD. That's a serious genetic lung disease, right? Current treatments are IV.
Mostly intravenous, yeah. So an inhaled version could be a big improvement for patients. Easier to use, better quality of life.
They tweaked the trial size?
Revised enrollment down slightly to about 180 subjects, but they're still on track. The really key thing here is the interim futility analysis.
Expected when?
By the end of this year, 2025, management called it a binary de-risking point.
Binary. Meaning it either looks good or it doesn't. Make or break.
Pretty much. A positive result would strongly suggest the drug works and significantly de-risk the whole program. That would position them for a potentially huge high-margin product down the road.
And the market for AATD treatments is already big and growing.
Huge. Already $1.3 to $1.4 billion, heading towards $2 billion. There's plenty of room for a new, potentially better option, like an inhaled therapy.
So if Innovate hits, it's not just incremental growth, it could genuinely change the company's profile.
Absolutely. They believe it's the most advanced inhaled program in a pivotal efficacy study for alpha-1. That first mover advantage could be massive.
Okay, beyond those big pillars, they're also keeping a tight rein on costs, it seems.
Definitely. Operating expenses actually decreased in Q2 compared to last year, down to $11.9 million from $13.3 million. We saw that discipline in Q1 too.
And that feeds directly into their goal of maintaining that 25% or higher adjusted EBITDA margin.
Exactly. It shows they're focused on profitable growth, not just growth at any cost. Growing smarter.
Makes sense. Anything else on the financial side? Taxes?
Yeah, they expect to use up all their carry-forward tax losses by the end of this year.
Meaning?
Meaning, starting in 2026, they'll likely pay a more normal tax rate, probably 20% and 25%. The weird tax number in Q2 was apparently just due to currency fluctuations. Shekel versus dollar happens with international companies.
And tariffs are an issue.
They assessed it, said no impact on drug products.
Yeah.
So that's a relief.
Okay, let's put this in context for investors. How has Kamada actually performed compared to the broader biotech sector?
It's night and day, really. Over the last year, Kamada's stock is up, almost 42%?
41.7%, yeah.
Remarkable. Meanwhile, the main biotech index ETF, XBI, is actually down about 13.5% over that same time.
Wow. Huge outperformance.
And it's not just luck. There are real industry tailwinds helping them. Like we talked about, that capacity-constrained market for plasma-derived immunoglobulins, IG products.
Right. Demand is high, supply is tight.
Exactly. That benefits companies like Kamada, especially now with their own increased plasma supply and their specific product mix. They're kind of in a sweet spot.
So going back to that market reaction on earnings day, the pop and fade, seems like the market maybe took some profits, digested the news, but the underlying story holds up.
That's how I read it. Profit taking, maybe some sell the news after the run-up. But analysts generally stayed positive. The core message from the company about profitability and strategic expansion, especially Houston, is strong.
And there are more potential catalysts coming up soon.
Definitely. In the next 3 to 6 months, we're watching for that EMA decision on the Houston Center.
Okay.
Continued rollout of those biosimilars in Israel, any new tender wins, and of course, the big one, that Innovate interim analysis is by year-end.
Lots to watch. Each of those could give the stock another boost, if positive.
For sure. They reinforce that narrative. More capacity, better margins, and the potential upside from the pipeline.
It is a compelling story, near-term drivers and long-term potential. Okay, time for our This Is Not Financial Advice segment. Let's brainstorm a slightly wild, but maybe, just maybe, plausible scenario.
All right, let's stretch the thinking caps, but keep it grounded in what we know.
Okay, here's the thought experiment. Highly speculative short-term. Picture this. Kamada, flush with cash. That brand new FDA-approved Houston Plasma Center humming along.
Generating plasma, generating cash.
Right. And they've explicitly said they're hunting for M&A targets, especially in transplantation. What if? What if they're not just looking?
What if they've already found something?
Exactly. What if they've quietly identified a small, maybe private, undervalued company, something in transplantation, a novel anti-rejection drug, a diagnostic tool that fits perfectly with their plasma business and sales channels?
Okay, I see where you're going. The outrageous part is acting on this hunch before any announcement.
Right. You place a speculative bet, maybe some short-term, out-of-the-money call options. You're betting that management's active due diligence is actually code for deal imminent.
And you're betting that such a deal, leveraging their cash, their new plasma capacity, would create immediate synergies and catch the market by surprise, causing a significant pop.
That's the outrageous part, the plausible part. Everything aligns. They have the cash, they stated the intent, they have the infrastructure, especially plasma. A small, smart, synergistic acquisition in transplantation could absolutely unlock value way beyond current expectations.
It demonstrates they're putting that new capacity and capital to work immediately for strategic growth. It's plausible, if highly speculative, a fun what if.
A definite what if. Okay, so let's recap the core takeaways from Kamada's Q2.
Strong profitability, beat expectations, raised guidance. That's key.
Strategic capacity expansion is huge. that Houston Plasma Center is a major development for supply and cash flow.
And the pipeline, led by Innovaite, offers significant long-term upside, with a major catalyst coming by year-end.
It all paints a picture of a company executing well and positioning for future growth.
But remember, everyone, we have to say this clearly. This has all been for informational purposes. It is absolutely not financial advice.
Please do your own homework. Dig into the company yourself. Consider everything we've discussed, but make your own informed decisions.
Your own research is always the most important step.
Thanks for joining us for this deep dive on TalkTickers.
Until next time, keep digging.
Keep asking questions.